Hello everyone, welcome to another episode of Personal Finance. Today we're going to look at retirement accounts and how RMDs are required minimum distribution apply to these retirement accounts. The first is your 401k and also your traditional IRA. 401k, typically you would contribute pre-tax money, it grows tax free, and at 59 and a half, you can withdraw the amount, but you will be taxed at your income bracket at 59 and a half and whatever age you withdraw the money. Similarly, traditional IRA, based on your current income limits, you might get tax benefit when you contribute. But if you're a higher income, then there's no tax benefit while you contribute. But the investments will grow tax free. And at 15 and a half, you can start withdrawing, but you will be subject to income tax based on your income tax bracket. These two accounts do have something called required minimum distribution or RMD. Today, the age is 73. So once you turn 73, you will be required to withdraw a minimum amount. How the minimum amount is calculated is the balance at December 31, the previous year, divided by your life expectancy. This information is published on the IRS website. So you might, let's say you have $1 million and might turn into that you have to withdraw $33,000 every year, right? So this adds on top of your social security and some other income you might have. So it might push you in a higher income bracket starting age 73. So this minimum age increases to age 75 from 2033. So 401k and a traditional IRA do have this RMD requirement. So if you look at the other retirement account, which is Roth 401k, which you would typically contribute post-tax dollars, it grows tax-free. And when you withdraw after 15 and a half, it is tax-free as well. Roth IRA, same concept. You may or may not get a tax benefit based on income limit, but it grows tax-free. And when you withdraw after 15 and a half, you are not taxed as well. It's tax-free at 15 and a half and above. But the significant benefit here is RMDs are not enforced for Roth IRA or Roth 401k. So you are not forced to make a minimum withdrawals on these two type of accounts. There's also something called Roth conversion ladder, right? For people who have large amount on their 401k, when they hit retirement, they could start making a conversion from your 401k into Roth. And that will be based on how much money you want to convert, and you have to look at your income limit and you'll be able to make the conversion so that maybe bulk of your 401k gets converted into Roth. So when you hit age 73 or 75, majority of your retirement account is on a Roth account, so RMDs are not enforced, right? So I will have a link on the description for the Roth conversion ladder, and we'll also have a separate video on that to go into details. The other one, even though it's not a retirement account, HSA or health savings account is a triple tax advantage account. The money that goes into this account is pre-tax. The growth is tax-free. The HSA money can be invested depending on your provider. You will be able to invest that money. And when you withdraw for qualified expenses, it is tax-free as well. All you have to do is keep the receipts. It doesn't have to happen the same year. It could have happened in previous years. And you can withdraw the money anytime you need it. Again, the expenses has to be medical expense, and you can withdraw based on your need as well. Again, we'll have a separate video. There are additional details on HSA. We'll go into more into that. Hopefully you have the information about RMDs. There is a link in the description that talks more into the calculation, how it is done. If you're interested, you can take a look. Hopefully this has been helpful. Thank you. Thanks for your time.